Hey everyone, welcome to the channel. Today we are going to discuss some of the thumb rules that you will see on the internet on a daily basis. I'm going to discuss the thumb rule and also share my thoughts about it so that you will get an idea whether to use this thumb rule in your regular life or not. So let's begin. Okay, first is the rule of 72. What does this mean? Rule of 72 basically means that whenever you are making an investment and you have an expected return of certain percentage, divide 72 with that percentage return to figure out in how many years you will double your money. Okay, so now let's take an example. Say for example, you do a fixed deposit of 8%, okay, and just assume that you are in a tax-free bracket. So you don't have to pay any tax on the income that you earn on the fixed deposit. So 8%, right? So in how many years will you double your money now? So let us use the rule of 72. 72 divided by 8. Basically 72 divided by 8 is 9 years. So in 9 years your money will double. So every 9 years at 8% your money will keep doubling. So whenever you are told that you will earn so many percentage of returns, this is a very simple thumb rule that you can use to calculate the number of years in which you will double your money. I think it's a good rule. It's a very good rule. There is no impact at all. So you should definitely use it. No downsides of not using it, right? Let's look at the next rule. Number 2 is the 100 minus age rule, right? So what does this rule mean? This rule basically means that how much should you allocate to equities. Use this rule to figure out how much should you allocate to equities. So now, say for example, you are 30 years old, okay? So 100 minus 30 is 70%. So basically this rule says that 70% is what should be your allocation to equities. And if you are 50 years old, you should have a 50% allocation and so on. I think it's totally a very bad rule that's out there. So complete thumbs down from my end for a simple reason, folks, that the older you grow, the richer you will be, right? And the richer you are, you would want your money to grow at better rates, right? Say if you are 50 and you've accumulated 7 crore rupees in your bank account, why would you want to only have 50% allocation when you are still earning active income, right? So this is something to think about. I think the better way to play this is to use a financial advisor or use the bucketing method, wherein you keep say 5 to 10 years of cash in your bank account or in debt instruments, and then anything over and above that you don't need after 10 years, just leave it in equity, right? So it may be, say for example, your annual expense is only 6 lakh rupees and you have 7 crore rupees. So you can park say 50 to 75 lakh rupees in debt instruments, and then balance can stay in equity. So it's completely depends on your personal finance situation. I think this rule should not be used at all. What is the next rule, right? So next rule is rule of 114. 4 is similar to rule of 72. This means that in how many years you will triple your money instead of doubling your money. So just divide the divide 114 by the rate of interest, or the expected return, and you can figure out in how many years you will triple your money. Next rule is 10-5-3 rule. Okay, so what is this rule? This rule basically means that this should be your return expectation from equity, debt and savings account, right? So 10% should be your return expectation from equity instruments, 5% from debt instruments, and 3% from savings account. Again, I think not a great rule to have, for a simple reason. Let me explain the thought process behind it, right? So why should you have, how much return expectation should you have from equity at all? So equity as an asset class will give you nominal GDP growth rate kind of returns, okay? So now what is nominal GDP growth rate? It is a factor of the GDP growth, actual GDP growth plus inflation. So if GDP is growing at 6% and inflation is at 6%, you can expect 12% kind of returns from equity. Okay. So this is what you should expect from equity. Debt. Now debt should be, the expectation in debt should be equal to the PPF rate, existing PPF rate. So if public provident fund rate today is 7.1%, that is what you should expect. Basically, the risk-free rate of return should be the expectation for debt. Savings bank account can differ. If some banks give you 6%, some banks give you 3%. So it completely depends on how much each bank gives. So ideally, again, not a great rule to have, because this will keep changing as time changes, as the economy grows and as economic progress happens. Okay, next rule is a very interesting rule which is called 50-30-20 rule, right? So this rule means that 50% of your total income should be spent on the basic needs, right? Needs as in roti, kapda, makan, so food, shelter and clothing. Then 30% should be spent on your wants. Wants could be things like you say traveling, or buying expensive gadgets or cars and things like that. And 20% should be saved. again a very very bad rule, okay? Because what a 50% 50-30-20 rule means is that at all income levels you should be applying this rule. It is not practical. Say you are starting your job, you will not be able to save 20% of your income, and once you have in 5 years of your job and you're earning 25 to 30 lakhs, if you're only saving 20% of your income, you are in deep trouble, my friend. So this rule is again, just discard it. Don't ever use this rule. So this rule should not be used. Ideally your savings rate should go up as your income increases, because the amount of money that you will spend on basics is going to stay largely same, except for the inflationary growth. And then wants is something that is in your control. So as much as you can control, please control. Idea should be to achieve financial freedom. Take a look at my financial freedom video to figure out how you can achieve financial freedom. So idea should be to achieve financial freedom, and based on that you can decide if you want to use this rule or not. I personally will not use this rule, so please do not use this rule at all. Next rule is the 3x or 6x emergency fund rule. So basically this rule means that you should have at least 3 times of your monthly income or 6 times of your monthly income in an emergency fund. So 6 times is fine, but again I would advise not to pay too much heed to this rule. Take a look at my emergency fund video. When you see that, you will understand that there are lots of factors that are required to consider when you are deciding your emergency fund. Say you have kids going to school, you have EMIs to pay, right? And you are the only person who is supporting the family. Then you should have a very high emergency fund of somewhere between 12 to 24 months. But if you are 4 people and everyone is earning in the family, and there are no dependents at all, there are no EMIs, and you don't even need 3 months of emergency fund, because somebody or the other can always support the family, right? So that's how you should think about emergency funds also. Ideally, no thumb rule should be used. It is a very personalized matter, and please focus on personalization here. Next is the 40% EMI rule. This basically means that your home loan EMIs and other EMIs should not exceed 40% of your income. Again, it's a good rule to have, but then when you commit 40% of your income to EMIs, life gets very difficult, right? So ideally, I would keep my EMIs to 20% of my monthly income, so that it does not burden me, right? And then I would also park the EMI money separately for 12 to 24 months in emergency fund. So again, this rule should be used with caution. Please make sure that you are making adequate provisions, right? So whenever you are borrowing money for home loan, make sure that you have a term insurance, make sure that you have adequate health insurance, make sure you have adequate emergency funds, make sure that you are not compromising on your financial freedom corpus goal, right? Because financial freedom, the contribution should continue. If you stop contributing to financial freedom, to your retirement corpus, and just contribute to your house, then you will struggle very badly in the later years of your life. Even though if you will have a house, you will end up being dependent on your children, or you will have to work for more number of years. So don't make that mistake at all. I hope these rules were useful. If they were useful, do not forget to hit the like button and also the subscribe button. Please drop a comment to discuss any question, any other rule that you think is useful here. We will connect again in the next video soon. Thank you for watching.